Anisha, who joins in with her next set of guests and ready to fire away with lots of questions, I'm sure, Anisha.
Oh, well, yes. Let's see whether I'm able to put these guys in the, corner as well and get some more details or not. But I do have, Samir Seksaria, the CFO, and Milind Lakkad, the CHRO of the company, joining me. And let me start by talking about the number which is making the headlines across all brokerage notes, and that's the margin resilience that we have seen. Very strong show. The exit rate, which was expected to be 25%, has already been delivered in Q3. But now you've raised the expectations. Talk to us about when are we reaching that 26% mark?
So I think delivering 70 basis points in this quarter on back of 110 basis points in the previous quarter is something which we are very happy about. And we don't give guidance, but we'll be happy with the momentum which we are seeing. And we stay focused on disciplined execution and operational rigor.
Oh, well, yes. But do you think the risks now are more towards downside in terms of margins, or do you see it only headed higher from here on? Because, I mean, Q4 is not seasonally weak, doesn't have a wage hike impact, so it should only trend higher, right?
If you look at it from an overall perspective, a quarter doesn't matter. Overall, if you look at the calendar year, it will have its pluses and minuses, and it's a portfolio which we need to manage in terms of we have certain levers and we'll have headwinds, and both need to be managed. Business continuity in terms of how the growth also pans out will have an important factor in terms of how margins will play.
Sure, and I'll scratch that point on levers further with you, but let me talk about the management of headcount right now and not just the cost management. In terms of attrition, that has come down significantly now. It's around 13.5% thereabouts. Do you see further room for it to contract, or this is a more steady state number that we should look at?
I'm very happy with and satisfied with the attrition number we have. People are the primary assets for this organization, and everybody has made a significant effort to get there. 13.3% is in a comfort range.
Yeah.
Will it go down further? Maybe. The answer is, I think, mostly yes.
Okay, mostly yes. But the other thing, Milind, everyone is talking about is how you managed to retain the mid and the top leadership, because your peers, and I don't want to name them specifically, but we all know that there has been a slew of exits that have happened at other companies, whereas at TCS there has been a steady ship. What do you think you're doing differently?
We are not doing anything differently. It has been like this for years and decades, and that is what differentiates us. That is the culture of the organization, the ethos, and the sense of larger purpose holds us all together. And there is no specific action which I have taken in the last 3 years which is any different than what we have done in the last 10 years. So I think this is something which is within us, and that differentiates us.
Well, I think that's the legacy, the pedigree that you're getting the benefits of right now. But talking about those levers, because the subcontracting cost has come down, I think around 8% or a little lower than that already. How much juice can you extract further from that? And even in terms of utilization and productivity gains, there has to be some sort of capping at a level. Do you think you've reached that level now?
So, as we have always called out, our long-term cost structures are aligned for us to operate in the 26 to 28% band. And it would have a combination of levers. The cost structures will depend on not only productivity or realization, the leverage, or in terms of pyramid, etc. We have been tapping on productivity better, leading to and utilization. This time productivity as well as realization has helped us on an overall thing. Coming to the question on the subcontractors, it was the demand supply mismatch and travel restrictions, etc., which caused it to peak. It peaked around almost near to 10%, 9.2 or 3 was our peak. We have brought it down to 6.1% now as a percentage of revenue. And depending on how the business environment continues, we can, tweak it. That's the easiest lever to tweak, because you can up it or down it basis. The contractuality of that is not as high, and that's the flex capacity which we get.
Is there a lower end which has been maintained over a, let's say, historical average in terms of subcon cost as a percentage of revenue?
you shouldn't look at it from that perspective. Yes, at a point of time we used to operate below 5% years ago. It is about the business mix and how much of how the environment is going on. I wouldn't cap it at a number.
Sure. But talking about the business mix, this time what supported the growth was BSNL deal to a large extent. And the street was worried that it's going to be margin dilutive given the nature of the deal. While I think it was a bit dilutive, you've managed it with the other gains. Going forward, as the deal ramps up, what do you expect the margin trajectory and contribution from BSNL deal to be like?
So, whether it is on the top line or on the bottom line, we are happy to take it as it is. It's a strategic deal which we have taken, and it's more, the deal is towards nation building, and it showcases our capability, unlike anyone else, to deliver such large complex programs, specifically on an emerging technology. As I'll not go into deal specific revenues or margins, but as a portfolio, like I talked about last time also, we would look forward to, we ask our portfolios to manage margins at their level, and overall also as a portfolio is where we'll try to optimize and drive efficiency.
Okay, fair enough. But Milind, what about the overall headcount decline? I'll just put a couple of points what naysayers are talking about, that the headcount decline is not only because of the business demand being a bit weak, it's also about the AI impact coming into the picture, the thing that people were fearing to begin with. Would you give any credence to that? Do you think this is anything to do with generative AI and how that's expected to hog into the jobs of people?
Anisha, I have been telling for last few quarters, I think we have made a significant investment in people in the last couple of years. Some of that is paying off now. That is one element. Efficiency of execution, like what Samir said, is another element. Which is what is primarily resulting in the headcount which you are seeing. Jain AI in the future may have some impact on the overall workforce, may not be from volume standpoint, because people will end up doing something else, and not the job description will change, and not volumes may not change. So this reduction that has happened has got only to do with those two elements, and not to do with anything with Jain AI at this point.
Okay, but the headcount decline pace has been close to 5,000 to 6,000 now for the last couple of quarters. Is this something which will continue for the next 2 quarters, a decline of, let's say, 6,000 per quarter?
I will not be able to quantify,
Sure.
but I will not be surprised if it is negative.
Okay, but we started off the year with the assumption that there will be 40,000 fresher hires, which is usually the case that you do. What have you done in the 9 months gone by?
Every quarter we are hiring, we basically onboarding all the freshers which we hired during the year, and that number is significantly high and not very different from what we used to do in earlier years. So that is going on. That is going on. They come in. Our talent, which is there for a couple of years now, from the talent we hired, they have gotten deployed in the last 9 months. So I think all of that together is contributing to where we are today.
Fair. But yesterday, Samir, in the press conference, we were talking about how market share of the company is also improving a bit. I want to understand from you, is it coming in with a bit of a stiff competition and pricing pressure? Because as we were discussing earlier as well, the pie is similar or shrinking a bit, but the competition is only increasing. Do you not have to twist yourself or, in terms of the margins a bit in terms of pricing of the deals now?
See, competition has never been easy.
It's getting tougher. It's never been easy, but it is getting tougher.
It's always been the case. Pricing environment, we believe, are stable. From a margin perspective, we have always said, or does it impact margins? Growth with profitability has been our mantra, and we'll never, give away one over the other. It's a combination of both, and that is how our businesses operate on. And it's anything which is strategic will not be left on the table just because the margin is expected to be. If we believe we can deliver and add better value to the customer, we'll go ahead and do that.
And is there a change in the way the deals are being structured right now in terms of the overall payments, let's say, or anything in terms of the value of the deal, how they're trying to bunch up the AI and other elements as well into the contracts? Is there any change in the nature of the deals and billings?
Nothing specific to call out immediately.
Okay, so nothing specific to call out in terms of the differentiation of deals, but coming back to work has been a big talking point across all IT industry, and there have been a few reports talking about how people have been forced to come back to work as well. What's the level of people who are working from office right now, and is it expected to go up further?
We have seen a big increase before the holiday, December holiday, and I expect that momentum to continue. Okay, and yes, we are at about 65% today, and I expect that number to go up.
And we're talking about how, artificial intelligence or Gen AI is expected to have an impact on workforce, not in terms of volume, but the nature of the deal. And you're doing a lot in terms of training your employees as well to get equipped with the power of this generative AI. Talk to us a bit more about that in terms of what's the entire workforce that is already equipped, what's in the pipeline?
So last quarter I reported 100,000 in basic Gen AI skills, this quarter I will say 167,000, that number has gone to. And now we also started building the next level of skills, and that is about 14,000.
Okay. And does it come with any additional costs in terms of L&D, or this is again par for the course?
See, all our margins are after the investments which we do, and probably a result of the investments which we do, and they are all baked in.
Okay. Any other monitorables that you're watching out for, Samir? Because in terms of the demand environment, at least the headlines that we read are getting better. Is this something that you are hearing a lot more in your client conversations?
So right now we also are keeping a close eye on it. We are optimistic that things will improve from here.
Okay. And last question before I let you go, the same question again that I posed to Kriti and NGS. If I had to ask you to rate demand environment right now between 1 to 10, where would you rate it?
I'll not get into it right now.
Okay, I'll let you go on that note. Thank you so much, gentlemen, for making time and speaking with ET now.
Thank you.
With that, it's back to you guys in the studio.
We'll pick it up from there. Anisha, thanks for, highlighting and that in-depth conversation really coming in with the TCS top brass here. The takeaway seems to be that clients pretty much are in wait and watch mode. But yes, things are looking up and they hope to better the order pipeline, which remains intact as of now. BFSI scale up, that's what they're aiming at first. That's TCS in trade for you. 37.35 is where it shut shop in trade yesterday, but seems like IT is headed for some big gains this morning.